What's up? I'm Dan Wijtenburg, and this is another chance encounter.
Hey, what's up? I'm Dan Wijtenburg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon.
I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Wijtenburg, and that there is a commercial real estate building.
Today I'm joined with John Wijtenburg. I'm struggling to get the white name. Remember, sure, it's white. It's not Wittenberg like Hamlet or whatever like that, and that's making me mispronounce things. But John, how you doing today?
I'm doing great, thanks. Thanks for having me, Dan.
Awesome. My pleasure. And I got some great news for you today, John. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here today? Well, it's because this is a chance encounter as featured on dandoesdeals.com, where I interview commercial real estate players. That means buyers, sellers, sponsors, passive investors, and all that kind of stuff. And you might ask yourself, why would you do that? And the answer is, if you know about compliance, if you ever do 506B deals, not necessarily 506C deals, well, the SEC requires that you have documentation of your prior substantive relationship, or else they'll get ants in their pants and they might take away your business in the form of rescission. And that's no fun. We want none of that. So I have people on here for 15 minutes and we talk about what's your core competency, your contribution to the deal, and all that kind of fun stuff. But before we get too excited into the real estate section, John, do you want to introduce yourself to the audience a little bit?
Sure. Appreciate it. Yeah, so I'm a hotel investor and asset manager. I got into this business back in 2012. I was a multifamily broker, and before that, I was an economist at Fannie Mae. But I was recruited to do acquisitions for large-scale hotels around top 25 markets in the U.S. Did that for a little while. I moved into asset management and raising capital. And then eventually, when everything collapsed in 2020, I joined up with a buddy to build a portfolio of extended stay economy scale hotels. Did that, built it up to 8 properties. And then at the beginning of 2024, I decided to leave that venture. I built a big team. It was operating by itself. And so I went off and started doing consulting and asset management.
I love it. And that brings me to the first section of our interview. The thing I always have to do before I start talking about the 5 distinct motivations, though, is say, but wait, check your 8. Now, John, I don't know what level of technical acumen you have or not, but maybe you can try for me to look into the camera and down into the user's device, because they might have this big hideous subscribe button down here, and maybe they should do something about. Okay, it's a stupid joke, and I've done it every single episode so far, so I gotta give them that little reminder. But let's talk about the 5 distinct motivations. Now, the important part of finding out people's motivations is if you have any chance of collaborating, partnering with people in the real estate space, you really should know what makes them tick, but more accurately, what's going to keep them from throwing in the towel when the going gets tough. And even though everybody has their own unique why, it might be a person, it might be another reason or something like that, I found that all of those different unique whys tend to fit pretty neatly into these 5 different categories, which we're going to go through right here. The first one of which is preservation of purchasing power. Let's scoot it over a little bit more. There we go. Preservation of purchasing power. What on earth is that? Well, some people, they've already got a portfolio of assets, so they're work optional. And so the question is, well, why would somebody in that situation want to make another acquisition? Well, there's a few reasons. One of them is when inflation rears its ugly head, it's going to eat away at the purchasing power of your cash flow. And so it's going to be time to make another acquisition. But the bigger reason that frequently frequently comes up. John, you mentioned it with what happened in 2020, is when there's an asset crash or a steep discount, it's time to pounce. And so, of course, everybody should try to get the deepest discount on their purchases that they possibly can. But the emphasis is that people in this situation, they don't have to take every deal that crosses their desk. They're going to be a little bit more conservative in the ones that they move on. And me personally, I'm not to this stage in my own financial investment journey. What describes me a whole lot better is trading time directly for wealth. I've got a background in tech. That's what brought me to real estate. Specifically, it's the CRM and web development online space. And I ended up getting into real estate through that avenue back in 2014. And as I got further into it and I learned more about real estate flipping and all that kind of fun stuff, I realized that I was on the wrong side of the right business. I was pursuing higher and bigger and better salaries. But if you are a physician or an attorney or an engineer or something like that, you'll notice that you have a bigger tax burden than anybody else. And so as a result, it makes more sense to find a way to be rewarded in the form of deployed capital, aka wealth. And that's why I decided, okay, I need to make these strategic partnerships, get into GPing and get the benefits of those equity multiples. So that's what I'm up to. And I get that's a little subtle for some people. A more common reason for people to get into real estate, whether they're younger or nearing retirement, is they want to fast track their retirement or they want to take control of their schedule. Now, of course, some people think that when somebody wants to fast track their retirement, they're eager to give up, and they think that basically everybody is secretly hiding the fact that they want to retire. But I assure you that is simply not the case. For example, some people, rather than trying to fast track their retirement, they're going to hustle into their 90s because they're more fueled by ambition. They want to buy their entire hometown. They want that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And that's what's inspiring them to keep working. And I get that in some circles, that sort of attitude is rather vilified. And I personally say that that's a little bit unfair because at the end of the day, you need somebody involved in these deals who will not go asleep at the wheel. They're not going to get complacent. They're going to keep on going and going and going. And that's why people who have this inspiration are very pivotal parts of a GP team. Now, the last group, they also are motivated to hustle into their 90s, but rather than being for their own edification, if I can say that, they've found a sector of society, or maybe it's animals, maybe it's the environment, who knows what it is, but they found out that there's a financial component to making a big impact, and so that's why they're making their commercial acquisitions. So, John, those 5 different motivations, what combination of them would you say describes you best?
Yeah, so I think there's a bunch of them. It's difficult to pin down, but one of the things that I love so much about the hotel business is that it's an operating business with a real estate component, where a lot of the other investments in the real estate space are more real estate business with an operating component. And so that allows you, by being an operating business, allows you to pull way more levers to add value. And as a sponsor, as an operator, you bring tremendous alpha that gives you returns far beyond what the market can provide. And so that's something that I really focus on, is like, where can we find the secret, the hidden areas of value generation, value creation in the asset. The other thing that's really important to me is having an impact through real estate. I think that real estate finance is one of the greatest powers for making an impact in the world. And particularly in hotels, 50% of our expense load is payroll. And so we can impact people's lives in the community and people who come visit the community, and really create a terrific ecosystem where we lift people up, we provide better lives, we can really create an environment where everybody wins, both the investor, the employee, the community, as well as the guest. So those are the things where I see a ton of value in what we do in the hotel space. And it goes deeper into some of these other areas that you pointed out. But I mean, everybody wants to build an empire, but having the systems in place so that it doesn't destroy you while you're doing it is so critical.
I love that answer. It's fantastic. And one thing that I find I have to be pretty careful about when I'm asking about the motivations, that sort of thing, is that it's pretty easy to seem overly optimistic, even bordering on unrealistic. And so that's kind of fun because this next question, it brings that down to the ground because we start talking about tolerance for risk. And if you've ever been involved in a 506B deal, whoever the securities attorney, there really should have been a securities attorney involved in the filing of your 506B and in your investment. It's a little bit of a red flag if there wasn't. But they should have insisted that you fill out this suitability questionnaire. It's this financial questionnaire with a lot of super invasive questions like your net worth, your investing history, that sort of thing. And when I was going through one of those questionnaires myself, there was one question that I thought it lacked utility. It didn't matter which of the multiple choices you chose. It didn't really give any insight on the truth of the matter, and it was the tolerance for risk assessment question. So for this interview, to find out my guest's tolerance for risk a little bit more accurately, I created a fill in the blanks question. Now, of course, the answer can be inside real estate or outside of real estate. It's both fine, but the question is, there are many popular investment asset classes, but I think blank is too risky. So John, if you like, you can do inside real estate, you can do outside real estate, you can do both if you want, but what are some asset classes that are too risky for you?
So for me, I think the Sun Belt is too risky. Kind of interesting coming from someone in Florida. I think the Sun Belt is too risky, and the reason I think that is that it's a really crowded space right now, regardless of where you're investing, whether it's industrial, office, retail, hotel, multifamily, whatever it is. The margins are so tight because there are so many people chasing those deals. I'm particularly looking now in the Midwest, Ohio. Ohio's a terrific market, Missouri, Oklahoma. Those are markets where there's still growth opportunity. People aren't paying too much attention to it. And that's where I think you're going to see the most growth over the next 10 years, because that's the heartland. That's where people are working, they're making, they're building, and a lot of the big companies see that. You see, Intel is investing in Ohio. You see Andrix, all these other high-tech aerospace defense contractors are putting money into these markets because they see the same thing that everybody else does, is that the Sun Belt's overinvested.
I love that answer. And at the risk of getting into the weeds, I know that our audience member doesn't want us to be all cookie cutter. So this is a really good point. When I first started putting out these chance encounters, because of my data background from the CRMs, I did go through the different data that the government offers. And I was looking for different migration data as far as like where were Americans moving. And of course, that was near COVID times. And I think a lot of boomers especially, they decided it's like, well, why am I freezing my butt off every single winter? And let's find some place where I can be a little bit better off, or remote workers, for example. And so I ended up putting all that effort into finding out where should people invest back like 5 years ago or so. And then I started doing these interviews, and I found out that when I asked people what their buy box is, then they just tell me for free with no effort. So I thought that was kind of funny. But like that, it's been 5 years since that big boost happened, and so with the cyclical nature of markets, I think that's a fantastic answer, and I think it shows a lot of insight. But let's get on to the next slide here, the next question, which is favorite deal metrics. I admit that when I first put out these chance encounter interviews, I thought that this was a little bit too much of a fastball for a lot of people in the space, maybe because it was so hot back, in 2022, 2021, that sort of thing, with different syndicators and whatnot. And some people were frankly more in a marketing role, a front of house, that sort of thing. And so I thought, asking them which metrics they tend to depend on, it was a little bit too unfair. But even if you are in that syndication space, the fact is you are going to focus in on few different metrics to make a lot of your decisions or compare the deals and figure out which ones you're actually going to put in your fund or that sort of thing. But for anybody in the audience who's only listening and not watching, I'm going to read out all of these. I've got 14 different metrics. It's not an exhaustive list, so you're free to go ahead and choose one that's not on here. But the ones that I have on here are cash on cash. I have IRR, which is internal rate of return, also known as an equity multiple. In other words, how many times your initial investment are they projecting that you're going to end up with after the deal has gone full cycle. Then there's the cost per door. There's the net operating income of the property. There's the going in cap rate, which is basically they're going to be talking about compare it to the other properties in the area. In other words, that's going to be a fast back of the envelope way to find out what sort of discount you're paying compared to the other properties that are nearby. There's the loan interest rate, which is especially important if you're going to be assuming a loan because of the lower interest rates from a few years ago compared to right now. There's the occupancy, which is the inverse of the vacancy rate. That's you'll have a slightly different number in hospitality, like a hotel, but in longer term rentals, like a multifamily, the occupancy rate is a key thing, especially if you're going to be looking for a non-recourse debt. But then we have the average income where the property is located to find out how affluent the population is. There's the amortization period of the loan, especially if you're going to be assuming the loan, you're going to want to know how long you have that loan, that interest rate for. There's the difference between the market versus the in-place rents. In that case, it'd be the per night or rate in a hotel. It's is the current management, are they undercharging? Is there an opportunity to make the place nicer and then make more per period of time that way? Then there's the population growth, which is what we were talking about with the Sun Belt. If a bunch of people are going to be moving into the area, there's kind of some baked in appreciation that's more likely than not because more people will need to find housing, so the demand will go up. There's the sponsorship record, which really means how many deals are on the go right now, how many deals have already gone full cycle. There's the waterfall, split, or exit strategy, which basically means what happens to my money after the investment or the project has completed. In other words, is it a refinance? Is it a sale? Are you basically left high and dry after you get your money back, or do you have returns after you've already had your principal returned? And then the last one I have here is DSCR, which is the debt service coverage ratio, which means how much of the revenue goes out the door immediately just to pay for the loan. Now, of course, as I said, that's not an exhaustive list, but John, what are some key metrics that you tend to depend on most?
Yeah, so in our business, we have three core values. It's honesty, creativity, and discipline. And these were chosen very specifically to look at these metrics in the right way. It's so easy to get into a deal because you need to make a deal. And that's one of the problems with a lot of fund operators and investment allocators is they lose discipline because they have to deploy capital. And so for us, we try to, or not try, we work really hard to make sure that we cover all our bases and set the boundaries appropriately. So what's very important for us is an unlevered cash on cash return and also the unlevered IRR. Because when you look at it objectively like that, you don't fall victim to financial engineering, which could make a bad deal look good, and also it could make a good deal look bad if you have the wrong debt. So that's one thing that's really important. We do not emphasize going in cap rate too much, or we don't really look too much at the cap rates, because the cap rates are, in our opinion, historical financial statements based on somebody else's operation. And so if we think that there's more upside or more potential either through more stringent asset management or investing in revenue generating activities, then the cap rate really doesn't mean much for us. The occupancy is critical, and that goes along with market demand. And so if you see supply coming in and you see demand just isn't there, that's something important to understand. But overall, I think those are the three that have the biggest impact on our review.
I love that answer. It's eating it up like a delicious subscribes. The sandwich is that intense enough for you? That's really something. But that's my reminder. It's time to pull out the Dan Does Deals Commercial Core Competency Cube. What's that all about? Well, it's got the 6 different roles in a commercial real estate deal. It does lean a little bit more on the multifamily side, but it does apply to other types of commercial properties. And I go through every side in every episode of Chance Encounters so that you know how my guest fits into these deals, because sometimes it's a little bit difficult to figure out. It's like, so what exactly is it that you do in these deals? So that's what this is for. And if you watch me go through these 6 different sides and you think, hey, I'd really like to have me one of those cubes. Well, the good news is absolutely free. You can go to dandoesdeals.com, which is rather inconveniently off the side of the screen here, which I'm fixing as we speak. Of course, it's going to take longer than I want to, but I guess that's the way things go. I also have, no, that's not going to do it. All right, I'll keep messing with it as we go along here and I'll fix that. But you'll go to dandoesdeals.com. There's this big conspicuous button where you can end up making that happen. There we go. I found the QR code already. But you can download that, and I don't even ask for any contact information, which admittedly, that's the cardinal sin of marketing. You should always ask for an email address or phone number or something before you give away your freebie. But I'm just that kind of guy. I want to make it easy for you. But let's get started. The most likely person you're going to run into in a commercial real estate deal is a repositioner. That's a public-facing person in general, and they in many ways are the brains of the operation, because they need to look at a whole whack of different deals and a whole bunch of different properties, do a whole bunch of paperwork. In other words, they need to underwrite the deal to figure out, is this property even making the amount of money that the current owner is claiming it is, or the broker is claiming it is? Have they done any of that financial engineering that John has already mentioned? But they're also figuring out how can they run this property differently to find more upside. And the most peculiar part of being a repositioner, at least in my opinion, is that they have significant financier relations involved in what they do. The fact is, real estate is highly capital intensive, so you're going to have to rub elbows with these financiers, because if you are able to secure a more advantageous loan, that's going to go straight to the profitability of the building, the property itself. So that is why the repositioners have to have a vast network of financiers, and these are people who only deal with paper and money and the owners. They do not deal with clogged toilets or anything like that. That job, of course, is the operations side. Now, of course, I have the image of the Benjamins going down the toilet, which is a big thing for operations, but it doesn't matter if you're in hotels or multifamily. There's more to operations than just unclogging toilets and collecting rents and fixing locks that are, tenants who are locked out and things like that. Me personally, in the past, my GP work, it's been related to the marketing and online component of my experience and skill set. And the thing that's really important is that if you understand real estate, especially this type of residential or even short-term residential, the fact is the enemy is vacancy. You're losing money if these units are remaining vacant. And so somebody on the GP team has to have some serious marketing chops, so that even if you're outsourcing the operations to a third party, somebody on the GP team can step in, get those units filled, and then turn that deal around. So that's where I throw my hat in the ring traditionally. And I'm always eager to speak to more people who are looking for that piece of the puzzle. But the next thing that a repositioner is likely to do is to get a contractor team involved to renovate the building, because if the building is nicer, then the future residents would be more than happy to pay more in rent than the current ones, as long as you do it within reason. Sure, you could go ahead and spend all the money you want. You could gold plate the toilets, but that's not necessarily going to convert to a higher net operating income. As a matter of fact, you also can't leave these contract teams to their own devices, because they'll drag their heels, or maybe they'll use subpar materials or something like that. And so the key part to keeping them in check is you need to have a local. If you're like me, see, I don't know if you know this about me, but I'm from the internet. So that means I rely on boots on the ground, somebody who lives nearby who can be there in an hour or two when problems inevitably arrive, because that's not going to be me. In an hour or two, I'd still be stuck at an airport, so I'm not ideal for the local boots on the ground role. But they are going to keep an eye on the contractor, and especially if you have third-party operations, they're going to keep an eye on the operations to make sure they're not, falsifying photos, and basically they're keeping up their part of the deal. But to understand the sixth and final role in the core competency cube, I like to use a little bit of a hypothetical about you. Yes, you in the audience. Maybe you're a physician, maybe you're an engineer, maybe you're an attorney, and maybe you have a few houses that are meant for long-term rentals or something like that. Maybe you have an Airbnb, and so you think to yourself, well, I know how to buy a house and turn it into a rental. I basically get my down payment. I go to the bank and I say, hey, lend me the rest. So you might get the idea in your head of, hey, if I talk to my peers at the hospital or at the firm or whatever, we each put in $100K each or something like that. I bet you we could buy that apartment building or that hotel down the street that has 350 units. So full of confidence, you turn around to the financiers, the banks, and you say, hey, I want to buy that building. It's tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, there's one piece of the puzzle that I haven't mentioned yet, and they're going to want to know who it is. They're going to say, who's the KP? Who's the deal sponsor? What's that all about? In order to be eligible for a loan, a commercial loan like this, somebody has to already own a similar asset. So if you want to buy a 350 unit apartment complex or hotel, well, somebody on the team has to already own a 350 unit apartment building or hotel. Then you also need, among the GP team, you need a balance sheet, in other words, net worth as collateral of at least the amount of the loan, and you need a certain amount of liquidity to prove that you can run the business without, running out of money and running the place into the ground with all the depositor money. But if you've got all that, you've got yourself a commercial real estate deal. So John, I know that you already mentioned some of the details of your role in your hotel deals, but for all the virtual assistants that are in the audience, they're frantically typing down everybody's details so they can reach out. What are the roles that you typically take care of in your deals?
Yeah, so I'm often the sponsor or the KP. And then also, if there's a high net worth investor or family office that owns an asset, I'll come in as an asset manager, which sits right between the ownership level and the operations level. And in hotels, that's particularly important because you often separate the brand, the management, and the ownership. And so by kind of acting like an owner's rep for the operations or for the construction, I supervise and make sure everything is going according to plan and optimize wherever we can.
All right, sweet. And while we're in the habit of repeating ourselves, let's get to the buy box. You already mentioned that you want to stay away from the Sun Belt and that you like Ohio. But when commercial investors, when real estate people are asking, well, hey, what's your buy box? We're really asking about three main things that we need to make sure are mentioned. The first one's geography. Where is it? Which states? Which county? Possibly even which neighborhood? We're talking about ideal properties, so that's absolutely important. The second one is size. Now, when you're talking about size, if you're talking about residential, usually we go by unit count or the number of doors. And the reason why it's relevant is because the type of person who is going to take over, 5 or 10 unit apartment complexes or hotels, they're going to be fundamentally different from the ones who take over 100, 150, 300 unit apartment buildings or hotels. So the size is definitely going to be relevant. Now, of course, there's other types of commercial properties that don't go by unit count or the number of doors. They go by square footage, such as warehousing and that sort of thing. But the idea of size being important still applies. Now, the third one is usually called class. I'm not very pleased with that term because class, it makes it sound like it's only one thing when it's actually two. Those two things are the condition and the area where the property is located. When you're talking about condition, we're talking about how old is the facility, the building itself. itself? How beat up is it? How recently has it been renovated? And then also, what kind of luxuries and amenities does it have? Does it have a hot tub? Does it have a swimming pool? Does it have ping pong tables? Does it have laundry on site? All of those sorts of things are really going to matter to the residents, and that's going to dictate the amount you can charge per night, per stay, or per month if it's an apartment complex. But if you're talking about the area, there's the old broker trope of location, location, location. I'm not crazy about that because I think they really mean traffic, traffic, traffic. If more people are passing by that property every single day, there's going to be more baked in demand than one where it's crickets all the time. If you're talking about residential, then you're also going to need to know what the school district is going to be like. And every type of real estate is also going to have demand dictated somewhat by the crime rate where the property is located. But both the area and the condition, they're ranked the same way as in grade school, where you have A plus at the top and then A and then A minus and B plus and so on. So John, as far as your ideal next property, go ahead and tell us again what you're looking for.
Sure, sure. So I focus in hotels, it's a little bit different the way that we talk about classes and quality. We talk about service levels, and the Smith Travel Research puts out a list of brands and where they stand in the chain scales. And so that's a reflection of their average daily rate, but also their service level. And so I focus on upscale, upper upscale, and luxury assets. The size, it depends because certain markets are more expensive than others. But I'm typically targeting a total capitalization of anywhere between 25 and $100 million. And so and then the minimum unit count of 85 units to make it economically feasible to bring in an operator. And then beyond that, locations, I'm really focused on iconic locations, iconic properties, mostly resorts, downtowns, and that sort of thing. I will look in the Sun Belt, but really focused on the Midwest and kind of underserved markets.
Okay, and so forgive my ignorance, both you and you in the audience. But where does that rate in terms of stars? So that would that be 4 and 5 star, and stay away from 3 star, or is that a good?
Yeah, so I will look at 3.5 star properties to see if I can rebrand them and renovate them to bring them up to 4.5 stars. But mostly it's 4 to 5 star properties.
All right, excellent, excellent. So then let's talk about my favorite part about real estate, which is people. The fact is, coming from tech, we tend to be pretty private people in general, and we're not exactly the life of the party more often than not. But in real estate, people are so eager to interact with each other, and I think it's because, quite frankly, it's a team sport. None of the people in real estate are going to be all 6 sides of the cube for any meaningful amount of time. Instead, people are going to hunker down on one side and really knock it out of the park and depend on other people for the other sides. So when people come on as my guest onto this show, I like to ask, so who out there are you disproportionately well suited to help? Me personally, because of my online presence and my marketing side of my skill set on top of the tech, I tend to be more of a twofer or a threefer or something like that. I tend to like to meet the sponsors and KPs more than anybody else because they already have that foundation set up, and I can make a disproportionate difference. Now, of course, everybody in real estate ultimately is in the industry of deploying capital. So, of course, people who are eager to invest and stuff like that, I also want to talk to them as well. But John, as far as the 6 different roles on the cube, who's out there that you tend to find you can help more?
Yeah, I can help folks who are sponsors who don't have exposure to hotels. So that's where I come in if they're building a mixed use development or they're getting into the market or they're looking to expand their hotel portfolio. I come in and bolt on and give them that additional expertise and subject matter discipline. The other area is, like you said, financiers. So I'm always looking for investors who want to invest in hotels or in some hospitality adjacent project.
I love it. I love it. And so now I'm sure people are really eager to find out how to reach out. Me personally, I'm pretty easy to find because just like John, I got a pretty distinct last name, and LinkedIn is the social media platform where I spend most of my time. So I'd encourage you to connect with me on LinkedIn. Of course, I've got some QR codes over here for some other services that I have. You can check out more episodes of Chance Encounter on dandoesdeals.com. Of course, my pet one, if you haven't seen it yet, is chesswithinvestors.com, where I have conversations very similar to this one I'm having with John, but we do it over a live game of chess. So if you want a little bit more exposure, make sure you connect with me on LinkedIn. Just go ahead and send me a direct message. If you're an investor or if you're involved in real estate, something related like that, then I'd love to have you on. But John, if people are eager to reach out to you, what are the best ways to make that happen?
So the best way to reach me is probably LinkedIn as well. I'm on the platform pretty regularly. I post daily, and always looking to connect and see where we can take the relationship.
All right, excellent. And that brings me to the final part of the show. I'm still trying to frantically fix that little gray bit that's in my background, but it's my public service announcement. It's not so much for John, but it is definitely for you. If you've been watching this episode and experiencing searing pains in your eyeballs and like maybe migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that's just down there. You can go ahead and hit it for free, and then it'll just be out of your life. It's like it'll be amazing. Okay, full disclosure, the reason I want so many people to hit the subscribe button is so those deadbeats at YouTube might actually start paying for these videos instead of me. I think that would be amazing. And the trade-off to you, just so you're clear, it just means that my videos may show up on your list of suggestions. There's no even guarantee that that's going to happen. And quite frankly, you can go ahead and ignore those suggestions because I just appreciate the fact that you spent this time with me. Just like John, I appreciate you joining me. This has been fantastic.
Yeah, it was a lot of fun. Thanks so much for having me, Dan.
All right, awesome.
Oh, hey there. I hope you enjoyed the show. And if you are into chess, if you play chess and you're an investor of some sort, real estate or otherwise, well, you can be on the show too. I know, right? All you have to do is connect with me on LinkedIn. My name's Dan Freidenberg, so I'm super duper easy to find on LinkedIn, where I spend most of my social media time. But if you're one of those people who just don't play chess, don't pay attention to him. I don't judge. All you have to do is go to dandoesdeals.com and you'll find the Chance Encounter series where you're welcome to be a guest on it, where you can share your core competencies that you're likely to contribute to a GP team or a JV. You don't have to be doing syndications. And we'll talk about your buy box and stuff like that. It's easy peasy. It's like 15 minutes long to record, and there are no real fastball questions. Just tell the truth and everybody will be fine. And if that's not really your thing, dandoesdeals.com, it also has the way to meet more, join more people, add more people to your investor list, your different deal sponsor operators and KPs and passive investors, all that kind of stuff. I'm probably repeating myself, but I'll give you the rest of your day. I appreciate you watching.